For the first time since April, we actually had a decline in housing inventory, and we had a massive 20% drop on new listings. We actually had fewer new listings this week than we did in the corresponding week of either of the previous 2 years. But we don't panic over 1 week data, we're looking for trends, and overall, excluding this week, inventory is looking more and more healthy every single week. And we've actually got 38% more homes on the market today than this time last year. We had 2 inflation reports come out last week showing that inflation is cooling quicker than expected. And although it's not enough for the Fed to cut rates just yet, it was enough to bring mortgage rates down, and we're finally back under 7% mortgage rates. We're breaking down those inflation numbers, covering all of this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're tracking things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, my favorite part is the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button, and if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is July 15th. Let's see what the data is telling us, and if this is an old video, you can click here to see the latest market update. First up is market news. If you'll remember, 2 weeks ago we got the BLS jobs report showing unemployment is back above 4% for the first time since November of 2021. The Fed believes there are still too many people employed, making and spending too much money, so they want to keep the federal funds rate high until the labor market shrinks back in order to prevent future inflation. So unemployment is clearly rising, and that was our first good sign when it comes to rate cuts. So now we add to that the CPI inflation report we got last week. So in that report, inflation cooled off 0.1% from last month and is down to 3.3% year over year. And I know that doesn't sound like much, but the evidence here is that inflation is meaningfully cooling off, and that increases the likelihood that the Fed is going to cut rates in September and potentially even one more time after that in 2024. Some traders are actually pricing in a rate cut at the end of this month, but I don't think so. As you can see on this chart, overall inflation has been in a clear downtrend since September of 22, and the shelter component, which is this top line, this number is important because it makes up the majority of this CPI inflation number. It's a lagging indicator because it's all based on the price of rents, and people don't renew their rents but maybe once every year. So even if prices are coming down now, they're not going to see that until these people renew their leases. So it's a very slow metric. It's always lagging way behind. So you can see it here. Overall inflation started its downtrend back in September of 2022, but the shelter component didn't start until March of 2023. But either way, both of them are in a very clear downtrend and have been for some time. So it's obvious that inflation is going away, and these high rates have been accomplishing what they were intended to do. So the fear the Fed has right now is if they cut rates too soon, they're afraid it's going to reverse this obvious downtrend and inflation is going to climb back up. So that's why we still have high rates right now. And a big part of that is because even though inflation has been cooling off for a long time, the labor market has still been looking way too strong. So as I said, now that unemployment is finally above 4%, that's the component we really need if we want to see rate cuts. So in my opinion, if we get even just 1 or 2 more reports showing that unemployment is rising and inflation is cooling, we're going to see our first rate cut in September. Now, what does that rate cut mean for you as a home buyer? It's really hard to say, but let me kind of outline some other factors involved. Okay, the first thing we're looking at is mortgage spreads. When I say this, I'm referring to the difference between the 10-year yield and mortgage rates. For example, if the 10-year yield is at 5% and mortgage rates are at 7%, that's a 2% spread. Do you get it? So in times of economic certainty, the spreads get better. When there's economic uncertainty, they get worse. So you can see last year, this bright red line, 2023, there were many times where the spreads were above 3%. That is really bad historically. Because you can also see here at 2022, the lightest line here at the bottom, at the beginning of 2022, we were still at spreads of better than 2%, below a 2% spread. So just to give you an example of how important these spreads are, let's just say the 10-year yield was at 5% at the beginning of 2022 and then 2023, okay? If the 10-year yield was the exact same number, mortgage rates would have been an entire 1% lower in 2022. even though the 10-year yield is the exact same. So this is a difference between a 6% mortgage rate and a 7% mortgage rate. And this has nothing to do with the Fed, not even anything to do with the 10-year. It just has to do with economic certainty. If people feel like there is stability coming, then the spreads will improve. And you can already see this line in the middle. We've certainly improved from last year, but we're not quite back to where we were in 2022. So what you need to know is, historically speaking, it's normal for the spreads to be under 2%. That would be normal, just like it was at the beginning of 2022. So just to give you a current example, today mortgage rates are about 6.8% and the 10-year is at 4.2%. So that gives us a spread of 2.6%. That's a high spread historically. So let's just say if tomorrow the spreads were to get back to a normal 1.8%, the 10-year wouldn't have to drop, the Fed wouldn't have to cut rates, and tomorrow mortgage rates would be at 6%, just from the spreads getting back to normal. That's how big of a difference this makes. Now let's say the spreads get back to normal, nothing else has changed, that puts us at a 6% rate, but then let's say later in the year, the Fed cuts rates 0.25%. Let's say that happens in September. Then you've got mortgage rates at 5.75% as early as November. Now obviously, there are a lot of big ifs in there because we don't know when the spreads are going to get back to normal, but I do believe if the bond market believes that the Fed is about to cut rates, then the spreads are going to improve. Because if rates come down, there's a much lower chance of the economy crashing. Specifically, it lowers the chance of mass layoffs. So the Fed wants unemployment to go up, but they don't want to break the labor market and crash the whole market. So my point is, it wouldn't take much to see 6% or lower mortgage rates, and that's just factoring in one rate cut. It's still possible we see 2 rate cuts. So all that to say, I do not think it's crazy to see rates below 6% by the end of the year. I'm not saying it has to happen, but it certainly is possible. And if there's one thing I know for certain, it's that there is home buyer demand below 6% rates. I know this because that is what home builders have been offering all year, and there has still been a lot of demand in new construction because of it. So if mortgage rates do get to 6% or lower this year, we're definitely going to see a meaningful amount of growth in the number of people buying homes. And I know nobody likes to hear this, but if rates do go down to 6%, then housing prices will go up. There are still not enough homes for sale to accommodate a large increase in demand. If you don't believe me, we have been at record low housing demand for years now, and prices have not dropped. If you increase the home buyer demand even 10 or 20%, then demand is going to outpace supply and prices are going to go up. And because we're working off record low demands, it would not take much at all to get a 10 to 20% increase in the number of home buyers. And I'm going to show you that here in a minute when we look at the charts for mortgage applications. But basically, just to get to the number of people who were applying for mortgages this week last year, if we just got to that same amount, that would be a 15% increase in demand. So if you buy a house today, you're going to be buying at a lower price and you'll still be able to refinance when rates drop. So if you can handle a higher monthly payment for 6 months to a year, I would be buying now before rates come down and prices continue up. To put it simply, in order to get the best price on something, you buy when demand is at its lowest. And demand is at its lowest right now. If you wait until demand increases, you simply will pay more. Okay, moving on. We're starting with national single-family housing inventory. This week, we actually had a small decrease of 1,120 less homes for sale in the country, which gets us to 651,453 homes available for sale. But before you get worried, you have to remember this data was from July 5th to July 12th. So that July 4th long weekend is certainly a factor here. As well as, this is just 1 week data. We only look for trends. But just for context, the all-time inventory bottom in 2022, we only had 240,000 homes for sale in the country. The peak of last year, we had 570,000 homes, and this same week in 2015, we had about 1.197 million homes for sale. So we're up more than double from the 22 bottom, but still need to nearly double again just to get to a normal market. But we are getting closer every single week other than this week, which is great. Now looking at new listings, as I said, we had a 20% decrease in new listings this week. Hopefully this chart gives you some peace of mind as you see the exact same thing happened in 2022. Of course, this has to be related to the 4th of July weekend. Now we didn't have that crazy crash last year, but we were already working off of record lows. However, it is concerning that this is, I believe, the first week all year that we've actually had fewer new listings than we had in 2023. And to get out of this supply shortage, we would need even more listings than we had in 2022. But now not only are we nowhere near that, we're actually below 2023. But again, this is 1 week data. We could bounce right back up here next week. So we're just gonna have to wait and see. The last thing I wanna say here is you can see this chart is gonna be trending down for the rest of the year, which means you will have less and less new options to choose from every single week. Even though inventory can continue up, those homes are going to be the ones you've already seen that you didn't want, that nobody else wants. Those are going to continue sitting on the market, having price decreases. But if you want a great house, I would not wait. You're going to be seeing less and less new options to choose from every single week. Now we're looking at pending sales. You can see weekly pending sales contracts data has been just slightly above 2023 all year long. This week we actually had that tiny gap is about 4,000 more homes pending than the same week last year, which is very interesting because we have way less people applying for mortgages this year, yet more pending contracts. In my opinion, this is because a lot more people are listing than they did last year. At least for most of the year they have been, and then those sellers are also becoming buyers. Then the last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we're up to 38.3% of homes having a price decrease. Last year we got as high as 39.2%. The year before we got as high as 43.2, but it is normal for this number to be increasing all the way up until about November. We'll have to see how high we get. We want this number to go up because it means higher days on market, which gives inventory time to stack up, and we need as much inventory as possible before we see rate cuts. Okay, moving on to mortgage rates, you can see we started at 7.01, we got as low as 6.82. You can see the big drop happened those last 2 days. That was because those 2 inflation reports came out. And then today, actually, it's looking like this number usually doesn't come out until later in the day, but somehow it's saying that we just had a small decrease. I don't think there's going to be any big moves until we get some other report or some data. I think we're going to hang around, realistically, somewhere around 6.8 to 7. Maybe we get up to 6.9 at some point, but until we see another inflation report or another jobs report, I think we're going to hang out around here, which is good news. And then regarding mortgage purchase applications, this week we saw a small 1% increase in the number of people applying for mortgages. I use this as demand. The number of people applying for mortgages, I see that directly as demand. If this number is going up, I say demand is going up. But as you can see, it's just been all these tiny little changes all year long, and there is really no reason to believe that mortgage demand is going to grow significantly with rates this high, which is why you still see a ton of new construction offering anywhere from 4.5% to 5.99% rates. Again, that's where demand is for home buyers. It's below 6%. And when I told you earlier that if demand increases 10 to 20%, prices are going to go up. I know that must sound like a big number, but if you look where we are today to just getting back to where we were in 2023, that little jump would be a 15% increase. Now, if we were to get all the way back up even to here, even to this dot right there, which is next week's number, even to this dot, that would be a 44% increase. That's just getting back to 2022's demand. So you don't think if we get to 6% rates by the end of the year, we're going to get at least up to here, and we're going to be back to 2022's demand in no time, which 2022 was still very low demand historically. And if that happens, 100% prices are going to go up. There is no way around it. Okay, before we move on to the local market data, 3 things. 1, I made a video last week showing you all of my top picks for where you should be buying a house based on your specific salary. I covered household incomes from $100K all the way up to $250K. So if you're interested in that, make sure to check it out next. Number 2, if you don't want to go broke buying a house, I've made a course for you, which includes a new and improved version of my max affordability calculator. It now has a budgeting feature where you can input your actual spending straight from your bank account, and it will tell you exactly the number that you could spend on a house. It takes out all the guesswork. It's a no-brainer for anyone who wants to have peace of mind about their purchase. And then number 3, if you just want to master the home buying process here in Texas, I've made a course for both new construction as well as resale homes. They are completely different, totally different contracts, totally different terms, different financing. Everything is different about the two. So if you're leaning more towards one or the other, check that course out. It'll tell you everything you ever need to know about buying a home. Links to all of that are down in the description below. below. Okay, now let's move on to the local markets, starting with the MLS data of Dallas County. And remember, last week is still skewed by the 4th of July weekend data. So it's gonna look like there are some bigger swings than normal. But in Dallas County, we had 644 listings. That's 179 more than last week. 324 closings. That's 102 more than last week. Of the homes that closed, 83 were immediate sales, meaning they contracted in the first week. 324 went under contract. That's 40 more than last week. In total, there are 2,278 homes either under contract or in pending status. That's one less than last week. Now moving on to Collin County, we had 521 new listings. That's 175 more than last week. 250 closings. That's 89 more than last week. Of the homes closed, 66 were immediate sales. That's 26 more than last week. 173 went under contract. That's 39 less than last week. And in total, there are 1,859 homes either under contract or in pending status. That's 53 less than last week. Okay, moving on to the Market Action Index. If you've never seen it, it just takes all of this data, puts it into one easy to read graphic with a number. Anything at 30 or below is a buyer's market. Above that, we're just asking how much of a seller's market are we in. Starting with Dallas County, we're still just at a slight seller's advantage. That's a 41. As you can see, and as is expected at this time of the year, we should have already seen the peak of prices. They should slowly be coming down through the rest of the year. Again, if rates actually do drop at the end of the year, that would definitely change this dynamic. Again, if we do actually see rate cuts by the end of the year, that could certainly change that dynamic. But as of now, what we're expecting is just a slow curve down until the next spring and summer selling season. But as you can see, median price of new listing back at the bottom of this range. It hasn't fallen out or anything yet. Median list price as well. It's been in a pretty small range for a while, since probably the beginning of May. Average days on market is climbing again, back to where it was, about in April. Median days had to jump up to 49 this week. Price decreases, 44% of homes had a price decrease. Inventory, slow, steady climb up. We wish that it was climbing faster. Again, we need as much inventory as possible before rates drop. And of course, the Market Action Index, which is just telling us how much of a seller's market, that's going to be declining for a while. Then looking at Collin County has definitely been cooling off the last few weeks faster than Dallas. As you can see, they dropped kind of out of their price range. They had been in that 590 to 600 range, and they dropped out of it down to 585 this week. Though the median price of new listings is still kind of holding steady within that range. Average days on market is climbing. Median days has not yet jumped, but average is what goes first. Number of homes having price decreases significantly higher than Dallas. It's at 52%. And in my opinion, a lot of this has to do with Collin County. A ton of it is new construction. So if you're listing your home out there, you're competing against the new construction and against these good incentives. And a lot of people, they may have a house that's 2 or 3 years old, and they're trying to price it similarly to these new construction homes, where the new construction homes are offering way bigger incentives. So those homes are going to be sitting. There are a lot of unrealistic sellers of older homes here in Collin County. But 52% of homes having price decreases there. Inventory, though, has been a much slower climb than Dallas. You can see, it's just a very slow growth there. But it's also a different type of growth, because there's a lot of inventory not accounted for here that is under construction. So just kind of a different market. But their Market Action Index definitely cooling off faster. It's down to a 39. Remember, 30 or below would be a buyer's market. Okay, now we're moving on to our top 10 ranked charts. These are the hottest and coolest cities and zip code ranked using that same Market Action Index number. Starting with Dallas County, the absolute hottest city remains Carrollton, Texas at a 60.58, followed by Louisville at a 53.46. But you can see Louisville had a big drop this week, whereas Carrollton did not. And then Grapevine heats up 1, Coppell remains, Lancaster cools off 2, Richardson heats up 1, Plano cools off 1, and then Garland, Ferris, and Duncanville all remain in the bottom 3 spots. Then we like to zoom in on specific zip codes. The absolute hottest is Carrollton 75007, then Carrollton 75010, Louisville 75067, Carrollton 75006, Plano 75025, Plano 75075, Garland 75044, Plano 75093, Grand Prairie 75050, and Garland 75040. So those are the hottest cities and zip codes in all of Dallas and Collin County. Now we're moving on. Same thing for the coolest markets. The absolute coolest for the first time is Leonard, Texas. For the longest time, it's been Van Alstyne. So Leonard cools off 1, Van Alstyne heats up 1. Sunnyvale remains at number 3, but is dropping off fast and is actually our 3rd buyer's market. So this is the first week we've had 3 buyer's markets. Remember, it's a 30 or below. Prosper cooled off 1 spot. Lavon heats up 1. Rockwall and Salina remain. Anna cools off 2 spots. Royce City remains at number 9, and Melissa jumps on at number 10. For the first time, I think I'm seeing Melissa on the coolest cities list, and Nevada was knocked off the list this week. Then looking at the zip codes, the absolute coolest: Leonard 75452, Van Alstyne 75495, Sunnyvale 75182, Prosper 75078, Lavon 75166, Mesquite 75181, Rockwall 75087, Dallas 75219, Dallas 75204, and Irving 75038. Those are the absolute coolest zip codes. Remember, if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. Call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.